Welcome, everybody, to Tokens of Wisdom. I am your host, Dave Rothschild, and we have a very exciting Intrasquad edition of Tokens of Wisdom today as I welcome my partner, Kevin Leiske, tax partner here at CFM. Before we dive into the episode, please listen to the disclaimer at the end of the show. Nothing I say, nothing Kevin says is legal advice or tax advice or investment advice, and so listen as such, and especially listen to the disclaimer at the end of the show. And with that out of the way, Kevin, welcome.
Thanks, Dave. Good to be here.
Do you want to give a quick intro of yourself and your practice?
Sure, I'll try to be quick. You'd think I'd have it down pretty well, having done it for so many years. But shockingly, I've been a tax lawyer now for almost 20 years, mostly, almost exclusively federal tax. Unlike what we're talking about today, which I am aware of, but mostly federal tax. And pretty much over that 20 years, it's been investment funds and M&A, in a variety of global centers of New York and San Francisco, London, advising any kind of investment fund you could think of, whether it's venture, crypto, hedge, private equity, real estate, and then all of the fun corporate issues that crop up at the companies they own.
Amazing.
Yeah,
you've been doing this 20 years. You've been doing this 20 years. It doesn't look like you've been doing it a day over 5 years. And I attribute that to your daily sauna ritual, of which I am very jealous.
Yeah, it is. It keeps the skin nice and tight and, stay out of the sun. Yeah.
So we are gathering here today to discuss San Francisco's gross receipts tax, which sounds terrible to me, but that's why I'm having you on the show to describe it to everybody as the tax expert that you are. So maybe to start, can you explain what is a gross receipts tax?
Sure. I will say too, it's a scary thing, especially when cities decide they want to start taxing people, whether it's San Francisco or New York. Always a little questionable. But a gross receipts tax essentially is if the highest level is you look at a business, you look at all the money coming in, and then the city is going to try and take a cut of what they believe is a gross receipt that can be associated with San Francisco. And we'll get into what that is. But whether it's because you have the business there or you are earning income coming from San Francisco, that's what they're trying to get to. They're just looking at, if you've got $1 million coming in and we think it's all, you've got an office in San Francisco, that's all subject to the gross receipts on a very basic high level.
Got it. So gross receipts is, total amount of money coming in essentially. Mm-hmm. And then we're going to figure out a way to tax it. Okay. So that high level makes some sense. So there's been news recently about some changes to San Francisco's version of a gross receipts tax. And can you briefly describe what is changing or what has changed that might be relevant to asset managers? Yeah,
for the longest time, and I don't know the exact year when San Francisco gross receipts tax was implemented. I'm not a great historian. Maybe I'm too old. I don't know.
That's a different podcast anyway.
Yeah. Yeah. For the longest time, it was based on your payroll. It was solely looked at how many people you had in San Francisco, and then it would apportion based on that. So if you have $1 million coming in, your entire payroll is in San Francisco, all of that's going to be subject to gross receipts. If you've got half your payroll is here in San Francisco, half of your gross receipts are going to be subject to the gross receipts tax. What they did, and it was a measure approved by the voters in 2024, is they now change the apportionment so that it's still 25% of your payroll, but the other 75% is based on where are your receipts coming from. So it doesn't look to where your business is, it looks to where your customers are. And for asset managers, if you've got limited partners or other investors paying you a management fee or even a carry, technically, we can get into that. That's technically sourced to San Francisco if they are in San Francisco.
So previously, the gross receipts tax only applied based on your payroll within the city limits of San Francisco. So if I have like you said, half of my employees in San Francisco, then half of my gross receipts are subject to this tax in theory. On the sort of the prior formulation of this, if I'm outside San Francisco and I have nobody in San Francisco, no employees, then I'm not paying any gross receipts tax in San Francisco. Now it's saying, okay, we're not looking at your headcount. We're not looking at where you're physically operating. We're looking at where your customers are. And in the case of asset managers, that might mean investors.
Yeah. And any San Francisco managers listening or watching to this right now will know this specific bit of history where they originally passed this law and it's based on payroll. And so a good amount of San Francisco-based managers just moved their offices to the Presidio because it's national land, right? It's not technically within San Francisco, and so they got out of it. But now they may be dragged back into it by nature of having San Francisco-based LPs. City didn't like that one.
Now they just live in the inconvenient to access Presidio for no reason. Well, not live in, but have their offices in.
Yeah. They live there. If they're working in this industry, they live there.
Fair enough. Okay, so that sounds problematic. So I'm a manager in New York. I have no business operations in San Francisco, no employees here, no office here. But I have a few investors in my fund who are San Francisco based. Now all of a sudden I have to pay a San Francisco gross receipts tax?
Yes. I mean,
my goodness.
So on the broadest terms, yes. And even worse, right? Say you're a London based manager, right? Or you're Hong Kong based manager. You've got San Francisco based LPs. Technically, you're subject to it. Now, the sort of savings here is that there's a minimum gross receipts threshold. And so your gross receipts have to be over $5 million for San Francisco in order to be subject to this tax. Okay. So if it's a small amount, you can figure out your LP base, or there are other ways to determine what should be sourced to San Francisco. If you can keep it under that 5 million total, you can probably avoid this, but you still have to do the math.
And you're saying that 5 million is gross receipts attributable to San Francisco investors, or is that 5 million total gross receipts irrespective of how much is San Francisco sourced?
5 million total gross receipts. And so, right, if you're taking 75%, I should be better, but I'm a lawyer, not an accountant. So I can't do the math in my head. But it's like if you have $6.5 million in gross receipts that are sourced to your LPs, take 75% of that, and then you get to the 5 million. You know, assuming you have zero payroll. I'm talking about New York managers, London, people outside of San Francisco. That's going to be their focus, or their level is once they get over 6.5 and change. That's when they're going to have to worry about this gross receipts tax.
Oof. It sounds painful. I mean, my first question is figuring out, how do I even know if someone is a San Francisco resident or is in the city for purposes of this tax? Like, I feel like there's a categorization problem here where the first step is figuring out who might be San Francisco based. Like, how should managers go about that?
It's such an onus on managers that really, I mean, I should say this also mimics what the Franchise Tax Board is doing in California. It's very similar. But the manager is supposed to look at, what's the address that the LPs gave them. And if it says San Francisco, then you just assume, unless there's other evidence saying they're not based in San Francisco, you just assume that's a San Francisco based LP. And there's also a look-through rule. So if you've got a fund of funds who invests, I mean, this is where it starts to get a little crazy. There's a long kind of description of this in the regs of, the address thing. You've got this look-through rule, but like, what are you supposed to do? Go to the manager now of the fund of funds and say, hey, tell me how many of your LPs are in San Francisco. I don't think they're going to give you that information.
No, I don't think so.
Yeah.
Okay. So I guess it's simple enough, right? You're going to get a subscription document from every LP. They're going to have to give you their address in that subscription document. And if their address says San Francisco, then you assume that they're San Francisco based, unless, there's some weird evidence outside of that.
Yeah.
So that's simple enough.
Yeah. If you have, say, the San Francisco Firefighters Union or Teachers Union or something is an LP, That's
Yeah.
obviously San Francisco based. Even if their
Yeah.
address is in Delaware, all the
Yeah.
constituents or all the beneficiaries are in San Francisco.
Sure. But then, your point about a fund of funds sounds like an absolute nightmare. I mean, are we going to have to start the only practical or even remotely reasonable way I feel like you could figure this out is if you started including a question in your subdoc that applies to fund investors, investors who are themselves funds that says, hey, you're a fund. Do you have any LPs based in San Francisco? And if yes, how many? And that just seems like a crazy thing to ask
No
people.
one,
It also
no
seems
one's
like,
going to answer.
it's a kinetic number, a hedge fund, people are coming in and going
Yeah.
out. Maybe they subscribe to your fund and then next month they get a new LP from San Francisco. It's insane.
I was talking to a practitioner about this specific issue yesterday, funny enough. And his suggestion was that you could look at the whole GDP of the US and then take a slice and say, how much does San Francisco make up of that GDP within the city limits? And then a portion based on that is your assumption. He's like, that's probably going to work. And it's only, I think he was saying it's like 1% of GDP. So 1%,
Yikes.
you just have to assume 1% of all fees from the fund of funds, if they're not asking you, are sourced to San Francisco.
Wow, that is insane.
Or yeah, if they're not answering your question. Yeah.
Unbelievable. Okay.
It's quite the burden.
Great. That does sound like quite a burden. So
Mhm.
my second threshold question is, does this apply to both management fee and performance allocation / carried interest? Is it one or the other?
It's only come up in the context as far as its application in its history, right? It has only come up in the context of management fees. I think if you read the law, they could apply it to the carry if they really wanted to and really understood it. Not that they don't understand it, but I think it's just that there's limited resources, and I think it is easier to apply to the management fee because that's really service income. With carry, it's an investment receipt is how it's characterized, and so that is exempt from the gross receipts tax because it's investment income is how we characterize it. But of course, everyone knows like that's up in the air of how you want to characterize it, and I agree with that. I do think it's an investment. I'm a tax lawyer in the industry, so of course I agree with that. But I do think it's investment income and it should be exempt, just like it is at the federal level, just like it is at the state level. But San Francisco isn't bound by those rules. So if they really decide, you know what, we're going to call this service income and we're going to go after it, I think there's a possibility they could. I don't know if they have quite the focus or the manpower to take on the industry, because I imagine there would be a pretty big pushback if that did come up.
Yeah, and I guess
Yeah.
this is a question I have for a little bit later, but I was wondering, do we have any idea how the city plans to enforce this? Because, as we've just been discussing this, it sounds like an absolute nightmare for any given manager to calculate this, especially if they have fund of funds investors. And so I think it sounds like an even larger nightmare for the city to try and enforce this.
I think it's going to be really difficult. I mean, obviously for the managers in San Francisco, that's pretty easy, right? That's not going to be hard for them. But for people outside, managers outside California, outside of the US, it's going to be very hard for San Francisco to discover that there are San Francisco-based receipts being paid out to these people unless they audit the LPs themselves, right? And find a way, ask them, where are your what funds are you invested in? Things like that, maybe. But it's a brand new day, starting next year. And so it's a real unknown of how they're going to enforce this and how aggressive they'll be about it.
That's crazy. I guess, practically speaking, Sam, I'm a fund manager. Will my tax preparer know about this and know to be asking me about San Francisco LPs? Because I assume the tax preparer isn't in the ordinary course going to know.
I mean, I think, obviously if you're San Francisco based, sure. I would
Yeah.
expect any CPA in the city to know about this and be on top of it. If you're somebody in New York and maybe you're using a regional CPA firm, they may not know, and almost zero chance they're going to know if you're international. I would, caveat that somewhat and say, if you've got a big four preparing your return, or maybe, some of the other almost big four firms, they've got a specialist in the area, a SALT specialist group. They'll be on top of it. But I think you start to go down the list and further away from the city, I think it's going to be harder for this to get picked up by the CPAs themselves, because it's just, I haven't even seen that much about this, surprisingly.
I haven't either, aside from the thoughtful note that you put out. So.
Yeah, that's right.
When does this go into effect?
Next year. It'll be next year. Yeah.
So it'll apply to, you mean I will have to pay this tax theoretically in 2026 for 2025 income, or
for 2026 income? So
okay,
27.
Okay. So I've got some time.
Yeah.
Very interesting. This all sounds super crazy to me. Is this an outlier? Is San Francisco way out on the fringe, or are other cities and states doing this also? I know you said this mimics what California is doing.
Yeah, California is doing something similar as far as if you've got income sourced to California, you're going to be subject to franchise tax here, or the franchise tax board is going to fine you essentially and subject you to California income tax. New York has something at a city level, this unincorporated business tax, but it's different. I mean, this gross receipts and this way of sourcing it to your LPs is novel, I would say.
Seems like something maybe that is ripe for a challenge. If some large manager gets hit with a hefty San Francisco tax that they weren't expecting, maybe someone will call you up and say, hey, let's fight this.
I honestly think it's possible. Or if one of the big organizations, gets behind it and wants to challenge it, it wouldn't surprise me. I think, what I've heard through the grapevine a little bit is people are running the numbers on it and saying, okay, it may not be a huge impact on the industry, so we may not want to get into this kind of brass knuckles legal battle about it. But it's ripe for a challenge if the dollars start to make sense, or it causes enough pain, particularly for if it's one large manager, say some New York manager with 5 billion AUM suddenly gets a huge tax bill here. They're not going to be happy about it.
Yeah, I guess it might depend a bit on how aggressively the city tries to enforce it.
Right. Yeah, that's the other thing, is it's unknown stacked on top of unknown. We don't know how big it's going to be. We don't know how much pain it's going to cause. We don't know how aggressive the city will be. We don't know if they're even going to pick up all the issues. So it's, for me, it's interesting to watch, but I feel bad for my clients who have to actually worry about it and write the check at some point.
Yeah, totally. Okay, well, this has been very helpful and illuminating, even if there are so many unknowns. I think what we do know is that San Francisco is taking novel approaches to try and extract another pound of flesh from asset managers, whether they're San Francisco based or not. So we'll see how this turns out. Never underestimate the city's ability to put the gross in gross receipts tax.
It's a good one. Yeah.
All right, Kevin. Well, thank you so much for doing this. I really appreciate it.
Yeah, thanks for having me on, Dave. I appreciate it too.
Absolutely. Okay, with that scintillating conversation out of the way, we can get to the part you've all been waiting for. The legal disclaimer. On this show, my guests and I discuss laws, regulations, and aspects of fund management from a 10,000-foot view. And nothing I say here, nothing my guests say here is legal, investment, or tax advice. Everything we say is our own personal opinion. Nobody is speaking on behalf of their employers on this show, and it is entirely for educational purposes only. If you're thinking about starting a fund or you're curious about what's involved, this show is a good resource as you explore your options. But if you're going to pull the trigger and actually launch a fund, please engage professional service providers to assist you in the process.